The morning of April 2, 2025, started like any other on Wall Street. Traders sipped their coffee, screens glowed with green numbers, and the S&P 500 hovered near record highs. Then, at 10:57 a.m. Eastern Time, everything changed. Donald Trump posted 500 words on Truth Social. Within minutes, $2 trillion vanished from the American stock market. Not because of war, not because of recession, not because of some corporate scandal. Because one man typed a message on his phone. Welcome to the new reality of American finance, where the stock market, once driven by earnings reports, economic data, and Federal Reserve policy, now dances to the tweets of a president, the cash pile of a 94-year-old legend, and the interest rate decisions of a central banker under unprecedented pressure. This is the story of power in 2025. Who has it, how they use it, and what it means for the trillions of dollars Americans have invested in their futures. The relationship between Donald Trump and the stock market has always been visceral, personal, almost romantic. He measures his presidency by the Dow Jones, treats stock gains as validation, sees market crashes as conspiracies against him. But in his second term, Trump discovered something that eluded him in his first. The stock market isn't just a scorecard. It's a weapon. On that April morning, Trump's post about massive tariffs on Chinese goods wasn't economic policy. It was a missile. The S&P 500 plunged 10% in 2 days. Nvidia, the AI darling that had minted millionaires for 3 years straight, lost 5%. AMD dropped 8%. Apple shed 3%. Tesla, led by Trump ally Elon Musk, fell 5%. By the closing bell, 424 of the S&P 500's members were bleeding red. But here's what most people missed. Trump knew exactly what would happen. This wasn't impulsive, this was strategic, because Trump had learned a crucial lesson from his first term: when you control the narrative about the economy, you control the economy itself. And in 2025, narrative moves faster than facts. The tariff threats were classic Trump, bold, shocking, designed to dominate headlines. But the real genius was in the follow-up. When markets cratered, Trump paused. Not all tariffs, just some. Just enough. Markets rallied 9.52% in a single day, the largest one-day gains since 2008. Analysts called it, Trump always chickens out. They were wrong. Trump wasn't chickening out. He was proving a point. I can move this market with a post. I can crash it. I can save it. I am the market. By year's end, Trump's tariff policy had raised the average U.S. import tax from 2.5% to 16.8%, the highest level in 90 years. Economists screamed about inflation, about trade wars, about damage to American consumers. But Trump's base didn't care about economics. They cared about strength, and the stock market, despite everything, was up 17% for the year. Trump's power over markets stems from 3 sources. First, tariffs. He uses them like a mob boss uses threats, constantly, unpredictably, effectively. One day he's slapping 50% tariffs on China. The next, he's exempting iPhones. Then he's threatening Brazil with 40% tariffs unless they drop charges against his ally Jair Bolsonaro. It's protection money dressed up as trade policy. Second, executive orders. Trump governs by decree, issuing orders that reshape entire industries overnight. Energy regulations vanish. Environmental protections disappear. Companies that spent billions complying with Obama-era rules suddenly find those rules erased. Markets love deregulation, at least in the short term. Third, and most importantly, Trump understands that markets run on emotion as much as data. Fear, greed, uncertainty, hope. He manipulates these like a conductor leading an orchestra. When he wants markets to rise, he promises tax cuts and deregulation. When he wants leverage in negotiations, he threatens tariffs and watches stocks fall. When he needs a win, he announces a pause and lets markets rebound. The Federal Reserve Building in Washington sits just blocks from the White House, but the two institutions occupy different universes. The White House operates on political time, election cycles, news cycles, tweet cycles. The Fed operates on economic time, quarters, years, decades. But in 2025, those universes collided, and at the center of the collision stood Jerome Powell, the Fed chair who refused to bend. Powell is 72, a former private equity executive who speaks in careful, measured tones. He's the opposite of Trump in almost every way. Diplomatic where Trump is combative, patient where Trump is impulsive, committed to institutional norms where Trump delights in breaking them. And in 2025, He became the most powerful person in American finance not named Trump. The Fed controls interest rates, and interest rates control everything. When rates are low, borrowing is cheap, companies expand, stocks rise. When rates are high, borrowing is expensive, companies contract, stocks fall. For nearly a decade after the 2008 financial crisis, the Fed kept rates near zero, pumping trillions into the economy. Then came inflation. Then came rate hikes. Then came 2025. Powell faced an impossible situation. Inflation, largely driven by Trump's tariffs, remained stubbornly above the Fed's 2% target, sitting at 2.8% in September. But unemployment had climbed to 4.4%, the highest level in 4 years. The dual mandate, price stability and maximum employment, was pulling him in opposite directions. Trump wanted rate cuts, not subtle hints, direct demands. He publicly criticized Powell, called the rate cuts too small, wished they were twice as large. He even floated replacing Powell when his term expired in May 2025. The pressure was intense, unprecedented, designed to break Powell's independence. Powell refused to break. In December, he delivered a rate cut, but a hawkish one, signaling no more cuts were likely. The committee was divided 9-3, the most contentious vote in years. Some members wanted more cuts to help employment. Others wanted no cuts to fight inflation. Powell threaded the needle, cutting just enough to avoid a rebellion but not enough to satisfy Trump. The markets reacted with confusion. The S&P 500 dropped initially, then rallied. Treasury yields spiked. Investors couldn't figure out whether Powell was dovish or hawkish, accommodative or restrictive. That was the point. Powell was refusing to be predictable, refusing to be controlled. He was asserting the Fed's independence at a moment when Trump was testing it like never before. Powell's true power became visible not in what he did, but in what the market thought he might do. In November, when Powell suggested a December rate cut wasn't guaranteed, markets dropped immediately. When he hinted at possible cuts, markets surged. He didn't need to act. The threat of action was enough. By year's end, Powell had signaled just one rate cut in 2026. Markets expected more. 68% of traders bet on at least 2 cuts. The gap between Powell's guidance and market expectations created tension. Who would be right? Who controlled reality? The Fed chair or the traders? Powell also announced something seemingly technical but deeply significant. The Fed would stop shrinking its balance sheet and start buying Treasury bills again. This quantitative easing light pumped $40 billion into the financial system immediately, with more to come. It was a signal. Whatever else happens, the Fed won't let the financial plumbing break. Warren Buffett is 94 years old, lives in Omaha, and still works every day from the same modest office he's occupied for decades. He doesn't use a smartphone. He doesn't trade frequently. He doesn't chase trends. And yet, in 2025, his decisions moved markets more than entire hedge fund industries combined. Berkshire Hathaway ended the year with $381 billion in cash and treasury bills. Let that number sit for a moment. $381 billion. That's more than Apple, Amazon, Alphabet, and Microsoft have in cash combined. It's enough to buy every NFL team and every NBA team with $34 billion left over. It's more U.S. treasuries than the Federal Reserve itself holds. Buffett built this cash mountain deliberately, systematically, over 12 straight quarters. He sold more stock than he bought every single quarter for 3 years. He dumped 600 million shares of Apple, his favorite holding, cutting his stake by 67%. He sold 41% of Bank of America. He trimmed Citigroup. He exited positions worth $133 billion in just the first 3 quarters of 2024. Wall Street watched this liquidation with growing alarm. Buffett's famous saying is, "Be fearful when others are greedy, and greedy when others are fearful." If Buffett was selling, what did he see that everyone else missed? The answer lies in valuation. Buffett has his own market indicator, total market capitalization divided by GDP. It's a simple measure of whether stocks are cheap or expensive relative to the economy. In 2025, the Buffett indicator hit 209%, higher than the 1929 market peak. For context, it peaked at 140% before the dot-com crash. Buffett was screaming a warning without saying a word, but Buffett's power isn't just about selling. It's about what he does next. Because when Buffett finally deploys that $381 billion, he'll reshape entire sectors. Every investor on Earth will be watching, analyzing, copying. That's not market power. That's market kingmaking. In 2025, Buffett made strategic buys that revealed his thinking. He bought 17.8 million shares of Alphabet, his first major tech purchase in years. He acquired OxyChem from Occidental Petroleum for $9.7 billion. He increased stakes in Japanese trading houses Mitsubishi and Mitsui. He doubled his position in Domino's Pizza and Constellation Brands. The pattern was clear. Buffett was finding value outside the US tech bubble. He was buying companies with real products, real profits, real dividends. He was positioning for a world where AI hype fades and fundamentals matter again. And when Berkshire stock outperformed the S&P 500 by 30% in the first quarter of 2025, everyone realized the old man was right again. Buffett's warning wasn't subtle. In his final shareholder letter before stepping down as CEO, he wrote, "Despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority of your money remains in equities." Translation: I'm not bearish on America. I'm bearish on these prices. He continued, "Berkshire shareholders can rest assured that we will forever deploy a substantial majority of their money in equities, mostly American equities, although many of these will have international operations of significance." Translation: I'll buy when stocks are cheap. They're not cheap now. The question haunting Wall Street is simple. When will Buffett strike? History offers clues. After the 2008 crash, Buffett swooped in with $5 billion for Goldman Sachs, $3 billion for GE, billions more for others. He made billions. After the 2020 pandemic crash, he waited, watched, then bought. He always buys at the bottom. Is 2026 the bottom? The market doesn't know, but it knows Buffett is ready. And that readiness itself is a form of power, the power to wait while everyone else panics. The question everyone wants answered is simple. Where does the market go from here? The answer is that nobody knows. Not Trump, not Powell, not Buffett. But we can identify the forces that will shape 2026. First, valuation. The S&P 500's CAPE ratio, a measure of price relative to 10-year average earnings, recently topped 39. Historically, when valuations reach these levels, the market either crashes or stagnates for years. There are only 2 ways this resolves. Earnings grow massively to justify current prices, or prices fall to match earnings. The first requires an AI revolution that actually delivers profits. The second requires pain. Second, interest rates. If Powell holds rates high to fight inflation, borrowing costs stay elevated, corporate profits suffer, stocks struggle. If he cuts aggressively to help employment, inflation might surge, forcing even higher rates later. There's no good path, only less bad options. Third, tariffs. Trump's trade war is real, ongoing, and escalating. The administration projects tariffs will raise $30 billion monthly in revenue. But economists estimate they'll reduce GDP growth by 0.2 to 1.3%, depending on retaliation. Corporate earnings will take a hit. Supply chains will remain disrupted. Inflation will stay elevated. Fourth, politics. Trump's term ends in 2028, but the 2026 midterm elections could shift congressional power, limiting Trump's ability to pass economic legislation. Markets hate uncertainty, and American politics has never been more uncertain. Fifth, the AI bubble. Nvidia's market cap exceeds $3 trillion based largely on AI optimism. Microsoft, Google, Meta, all betting billions on AI infrastructure. But when do these investments pay off? When do AI applications generate profits that justify current valuations? Nobody knows. And if the answer is not soon enough, the carnage will be spectacular. Sixth, consumer sentiment. The University of Michigan's Consumer Sentiment Index hit 57.9 in March 2025, the lowest reading in its history. Americans feel pessimistic despite official economic statistics showing growth. This disconnect matters. If consumers stop spending, the economy collapses. Their feelings matter more than the data. Seventh, Buffett's move. When he finally deploys that $381 billion, markets will follow. If he buys US stocks, it signals confidence. If he buys international stocks or private companies, it signals continued wariness about US valuations. Wall Street analysts are split into three camps. The bulls argue that AI is a genuine revolution that will drive productivity gains and earnings growth for decades. They point to strong consumer spending, resilient employment, and the Fed's willingness to support markets. They see 2026 as another year of gains, perhaps more modest than 2024-2025, but positive nonetheless. The bears argue that current valuations are unsustainable, that tariffs will strangle growth, that Powell's hawkishness will trigger a recession, that the AI bubble will pop. They point to Buffett's cash pile, to inverted yield curves, to slowing hiring, to declining manufacturing. They see 2026 as correction year, possibly a crash year, where reality finally catches up to fantasy. The pragmatists argue that markets will muddle through. Some sectors will soar, others will crash. Stock picking will matter again after years where, just buy the index, worked. Diversification will matter. Cash will matter. Patience will matter. They see 2026 as a year that separates skilled investors from lucky ones. One scenario gaining traction is selective crash. The idea is that the AI bubble pops, tech stocks crater, but value stocks, international stocks, and dividend payers hold up. The S&P 500 might fall 20%, but the Russell 2000 small caps might be flat. Berkshire might rise. This would be devastating for passive index investors but create opportunities for active managers. Another scenario is Trump crash. If the Supreme Court rules Trump's tariffs illegal, a case actively proceeding through courts, the government might have to refund $90 billion in collected tariffs. To do that, Treasury would issue bonds, flooding the market, spiking interest rates, crashing stocks. Trump himself warned this could trigger a depression. He's not wrong. A third scenario is soft landing impossible. The Fed tries to thread the needle but fails. Either inflation accelerates, forcing rate hikes that kill growth, or recession hits, forcing rate cuts that reignite inflation. Stagflation, the nightmare of the 1970s, returns. Stocks and bonds both fall. Cash becomes king. For individual investors, the message from 2025's power players is surprisingly consistent. Trump says tariffs will protect American jobs and industries, but his own actions show he knows they're negotiable, temporary, theatrical. Don't bet your portfolio on Trump's promises. Bet on his unpredictability. Powell says the Fed will be data dependent, but his own projections show deep divisions within the FOMC. Don't bet your portfolio on Fed guidance. Bet on volatility and be ready to adjust. Buffett says nothing explicitly, but his actions scream. When the world's greatest investor holds 31% cash, you should probably hold more cash than usual. When he's buying international stocks and value plays, you should look beyond US tech. When he's patient, you should be patient. The practical steps are clear but hard to execute. First, hold more cash than feels comfortable. Maybe 20 to 30% of your portfolio. Yes, you'll miss gains if markets rise. But you'll have dry powder if markets crash. And the opportunity cost of missing a 10% gain is far less painful than the reality cost of suffering a 40% loss. Second, diversify beyond US tech. The Magnificent Seven stocks, Apple, Microsoft, Alphabet, Amazon, Meta, Tesla, Nvidia, drove most of 2024 to 2025's gains. They're expensive. Their dominance can't last forever. Look at small caps, international stocks, value stocks, dividend payers. Third, buy quality. In frothy markets, garbage floats. In corrections, garbage sinks. Companies with strong balance sheets, consistent earnings, low debt, and real products will survive whatever comes. Speculative plays won't. Fourth, ignore the noise. Trump will tweet, markets will swing, headlines will scream, none of it matters to your long-term returns. The best investors of 2026 will be those who turn off CNBC, delete their trading apps, and stick to their plans. Fifth, remember that market power is temporary. Trump's term ends. Powell's term ends. Buffett is retiring. The power players of 2025 won't be the power players of 2030. But the principles of investing, buy low, sell high, be patient, manage risk, are eternal. The American stock market in 2025 is a battlefield where presidents wield tariffs like swords, central bankers defend independence like castles, and legendary investors position for apocalypse. It's thrilling, terrifying, unprecedented. But it's not new. Markets have always been about power. We just rarely see it this clearly. Trump's Truth Social posts, Powell's press conferences, Buffett's quarterly filings. These aren't just news events. They're signals from the people who actually move trillions. Pay attention to what they do, not what they say. Trump talks tough but blinks often. Powell projects confidence but worries deeply. Buffett expresses optimism but hoards cash. The market will do what the market does. It will rise until it falls. It will fall until it rises. Your job isn't to predict it. Your job is to survive it. The investors who thrive in 2026 won't be those who guess correctly about Trump's next move or Powell's next cut or Buffett's next buy. They'll be those who build portfolios resilient enough to handle whatever comes. Because here's the secret that Trump, Powell, and Buffett all know but rarely say. Nobody controls the market. Not really. Not for long. The market is 8 billion humans making trillions of decisions every day. It's algorithms, emotions, accidents, innovations. It's too big, too complex, too alive to be controlled. But it can be influenced. And in 2025, 3 men influenced it more than anyone else. Watch them, learn from them, but don't worship them, because the greatest power in markets isn't moving them. It's not being moved by them. It's staying calm when everyone else panics. It's buying when everyone else sells. It's thinking for yourself when everyone else follows the crowd. That's the lesson of 2025. That's the strategy for 2026. And that's the wisdom that will matter long after Trump, Powell, and Buffett have left the stage.